Hey guys, welcome to the first lesson of CA tax module. Now the first thing that you want to do is open up your website and actually download the notes I've provided for you. I've split the first chapter into 4 sections: income, residency, deductions, and trading stock, simply because it's the longest chapter of the whole textbook. So don't feel discouraged about the length of the first chapter, because it is by far the longest chapter in the whole CSG. Don't worry, the rest of the chapters, they might get a little bit harder, but they're definitely not as long as this chapter. Anyway, let's get right into it, into the first income section of the first chapter. I've split this video into 4 parts. This video will only be focused on one, income. I'll watch the other videos following this one to go through residency, deduction, and trading stock. Anyway, let's get right into it. So open up your notes in front of you. Just a little side note as to how I'm going to approach this. I'm going to go through it quite quickly. The whole point of the CSG is it provides you with very in-depth, detailed notes. But what I'm going to be doing is just going through and telling you exactly what you need to know. I'm going to skip everything that you can just read exactly from the notes in the exam and just tell you what you need to learn and understand. So just starting off with the basics about income tax. So these are just the formulas as how the income tax amount is actually calculated and paid to the tax office. So we start off with taxable income, which is actually defined down here as well. It's basically just assessable income, i.e. your wages or your work or your dividends from shares, etc. Less any deductions that you can apply against that income to reduce your taxable income. Once you get this amount, you times it by your tax rate. Now, in Australia and New Zealand, we have a thing called marginal tax rates, which basically means that the more income you earn, the higher rate of tax you pay. So the tax rate will depend on what tax bracket you're actually in. Now, the last part is offsets. Now, offsets are different from deductions because deductions reduce your assessable income to calculate taxable income. So taxable income goes in up here, times your tax rate. That calculates how much tax you get to pay. The offset is better than a deduction because it actually offsets the tax that you're being paid. So it's basically worth the tax rate that you're on, whereas the deduction is pre your tax rate. So offsets are always preferable to deductions. Now the formula down here for tax losses is slightly different, but don't get confused by it. I think it can be a little bit misleading. Just use common sense. Basically, if your assessable income is less than 0, you're going to have a tax loss. The other concept to probably consider here is that income or assessable income is made up of 2 different types of income. So the first is ordinary income and the second is statutory income. So ordinary income is probably everything that you're familiar with in terms of rent, dividend income, wages, personal income, most types of ordinary income. Statutory income is specifically defined in the Act, and it only covers a few very specific things. Probably the most common thing is capital gains. Now, it's probably important to remember these section references here as well, and you'll see them underneath almost every section of these notes. Now, tax is different from the other modules in that you really need the section references. You don't need it for the other subjects, but you need it for tax. So whenever you write an answer, you need to include the section reference as well. I usually tell my students that if they're not really sure which section reference to use, for example, they've got a mind blank or they've lost their notes, this note should have everything you need, but they don't have them. The 2 most common ones you can use, if you can't think of a specific section reference to use, is ordinary income, which is section 6-5, or deductions, which is section 8-1. Now remember this one. Statutory income is section 6-10. It's basically capital gains and a few other very specific things which don't come up very often. Now let's keep scrolling down. So we're going to go through some examples of ordinary income, and I'm going to skip through them a little bit quickly as well, because you don't necessarily need to know or understand what they are, because they're quite logical, self-explanatory. The thing you do need in an exam is you need to know the relevant case. because sometimes there's a specific case which is more applicable than the section reference. Let's go through some examples down here. So arising from employment of services. So of course anything like this is ordinary income and it falls under section 6-5. However, certain exam questions you also need to use the case reference. So amounts incidental to employment or services are ordinary income. So this is also per section 6-5, but the case that set the precedence for that was Kelly versus FCT. So you can kind of see how this is self-explanatory. Arising from business. So business income, that falls under ordinary income. Income that's typically periodic, recurrent, or regular. Dixon versus FCT. So these kind of questions are important because back in the days before capital gains tax, a lot of people, to avoid tax, they used to argue that their income formed part of capital income. Therefore, it would be a capital gain. They wouldn't have to pay capital gains tax on it. These days, it's not as important because both, after 1985, both capital gains and personal income, ordinary income, go into your personal tax return as assessed at your own marginal tax rate. However, it wasn't the case back then. It is somewhat important these days because there's CGT discounts, CGT exemptions, and you might have a CGT, a capital loss from a previous year which you want to use to offset your capital gain. So there are some tax advantages to kind of trying to argue that a certain income is capital over income still, but to a lesser extent. This is why this is important. So this is saying that income is typically periodic, recurrent, or regular. So things like a wage, you get it every fortnight or month. The dividends, you get it regularly, quarterly. However, if you sell your house and it's just a very large one-off payment, it's likely to be capital. And if you get that in an exam question, you can reference Dixon versus FCT or Harris versus FCT. Okay, so moving on. So let's read through this. So not capital amount, more details below. So this is just talking more about the distinction between capital and income. So have a look over here. There's a good case over here, Eisner versus Maycoma, which is using an example. It's more for your own benefit as to understand the difference rather than in an exam, but a capital income amount would be the sale of a tree which produces a fruit. You sell the fruit at the market, that's your income. But if you sell the tree or the tree gets destroyed and you get reimbursed for that tree, that would be capital income. So just moving on forward. So personal gifts or windfall gains are not income. You might get a trick question in the exam, like a lottery is not assessable income because it's a gift under Scott versus FCT. An isolated transaction in the course of carrying on a business may be income. So even though a transaction could be isolated, you could argue that it's capital because of that. If it's in the purpose of carrying on a business, it may be income. That's FCT versus Meyer Emporium. So a lot of the questions will kind of, it's not a strict answer whether it's capital or income. You're weighing up the facts and kind of making an informed judgment. That's how you kind of answer these questions. So it's in considering all the facts of the case, whether it was isolated, whether it was recurrent, periodic. Okay, so moving on. So money must be in money or convertible into money to be ordinary income. So non-cash benefits. So it excludes non-cash benefits received in employment contacts because FBT covers that, which we'll be doing a later topic, and in a business context. So there's this very small question that you might get a few marks on, which is about Section 21, which covers the benefit if it was convertible to cash. We'll talk about that a little bit later. So compensation for loss of trading stock. So I know this can be a little bit boring and hard to start off with this. This first chapter is a little bit all over the place. They're just very random examples, but you will get questions on them later on. So it is good to just go through them one by one. So compensation for loss of trading stock. So usually when I used the example before about the tree makes the fruit. Selling the fruit at the market would be income, but if the tree, which is capital, gets destroyed, that would be reimbursed as capital. So generally things are either on a revenue account or a capital account. However, this is saying that trading stock, there's a quasi third account called trading stock, which we'll talk about a little bit later in more detail as well in later chapters. But they're saying here that if the trading stock, if you receive compensation for it, it'll be on income account, not capital. Okay, so moving on. So we're talking about derivation of income. So there's a very basic concept in both accounting and tax. So it's talking about this distinction between cash and accruals. So for most small businesses and also non-business taxpayers, they use cash basis, whereas if anyone is in a business or a large business specifically, they're required to use accruals method. Now the basic difference between this is when, for example, income, when do you recognize income? Do you receive it when you get the cash from it, or do you get it when you've earned it? For example, when you issue an invoice, you haven't received the cash for it, but by issuing the invoice, you've earned that work because it's deemed to be collectible. So this is just talking about what we were just saying before about non-business taxpayers should be using what the most appropriate is cash. However, you do also need to consider like what kind of income type it is as well. For example, is it interest? So we talk about some derivation of income rules down here. Salaries and wages, trading income, when we should actually be recognizing them as income. Now this is actually important for some tax questions later on. For example, when we're doing a tax rec, we need to know when to recognize the income. And a common question that you might get asked is, in the exam, they've recognized the income in this financial year, but you need to consider, should this actually be recognized next year? So then we have to actually reverse out that income, and that'll be your mark in your tax rec. But I'm getting ahead of myself now. So let's just move down here into some of these specific derivation of income rules. So salaries and wages, these are recognized on receipt. So when you actually receive it, so it's on a cash basis. Interest, you have to consider a few different situations. Are they an individual investor? If so, the income is on receipt when you receive the money on a cash basis. However, if it's on overdue accounts, it's on accruals basis. For example, you might have a debtor which is not yet paid and you've specified that they must incur interest. You wouldn't recognize that income when you receive the cash. You might not receive the cash. You recognize it throughout when it's earned. And the last one is interest from financial institutions like banks, etc. That's on an accrual basis as well. Trading income. So this is, for example, a plumber issuing invoices. So this is actually, it becomes income, or recognized as income when the debt becomes due. So this is basically on your invoice, what date is this invoice due? That's the date that it needs to be recognized in your P&L and tax return. So there's a few different situations down here, some with case law. So when goods are supplied at sale or delivery, even if paid in installments. So I guess when you've provided the goods, that's when you've earned it. It really depends on the situation. When goods sold on lay-by, when first installment is paid and goods are delivered. Okay, so this is a very specific example that you need to remember. Where there is a dispute over an amount owing, amount is not assessable until resolved. Fair enough, BHP Billiton versus Petroleum. What about dividends? Dividends are when paid / credited. So it's not, the trick is it's not when it's announced, it's when it's actually paid / credited. Unless, of course, it's reinvested. Then it's constructive receipt, which means it's when you instruct them what to do with it. So that's section 44 and tax ruling 98/1. So rent is when received, unless they're in the business of renting out properties, for example, holiday home, etc. which would be, then we go back to our first point up here, so it's a business, so you need to be on accruals basis. Professional services income. So this is a trick one, and it often comes up in those quizzes, those 10-mark quizzes. So it comes down to these two questions. So if it's dependent on a practitioner's own skill and expertise, it's cash basis. However, if it's part of a large professional practice, think of a large accounting firm, it will be on an accrual basis. So plumber, sole trader plumber, cash basis. Large professional practice, accruals. Here's relevant cases over here. Okay, WIP, so works in progress. So this could be professional services, billing time or it could be a manufacturer. But basically, you don't recognize this as income until it's earned, right? And it's not earned until it's billed. So you consider it a WIP balance, but unless you've actually billed that amount, it's not revenue. Unearned income. So this is basically when you've done the service, but you haven't received the money for it. So it's derived when the services are rendered. So you still need to recognize this as income, even though you haven't actually received the cash for it, which can be a problem for many small business owners when they have to pay GST on a service, especially a large service, when they haven't received the money from it from a customer. Long-term construction. Fortunately, we don't get too many questions on this in exams. Basically, all progress payments, final payments in a year are assessable, so that's cash basis. But you get a choice of two methods. That's the first option. The other option is a estimated profit. So it's basically you calculate the profit over the entire thing, and then basically apportion it across the life of the project. Both of these are available in Income Tax Ruling 2450. Okay, that one very rarely comes up. Agent's commission when debt when it becomes recoverable debt. So I don't think I've ever seen that in an exam. Okay, so that was all ordinary income. So let's actually move down to statutory income and the specifics of that. So if it doesn't fall under ordinary income, it comes under statutory income, which is section 6-10 of the Income Tax Act 1997. So there's a few I mentioned before that it's very specific. So if it doesn't fall under ordinary income, if it doesn't fall under very specific instances of statutory income, then it's ordinary income. So the first one that's specified under section 15-15 is the gain resulting from a profit-making undertaking. For example, you might have decided to flip a house, renovate it and sell it very quickly. That was a profit-making undertaking. That would be a statutory gain. However, if you are in the business of renovating properties, that is your business, and it so happens that you sell a house as part of this process, will be ordinary income. Another situation is when you're a developer, and then an apartment could actually be on trading stock. But I'm getting off topic here. So just understanding what that profit-making undertaking actually means. So it's carrying out a process in order to make a profit. Now, this is different from carrying out a business because this is something you do regularly. It's not something that happens quickly and turns around and you're done. It's one-off, make a profit. Now, of course, there's some exemptions to this. So if the property was acquired after 1985, which is CGT, because it's probably already subject to CGT. Where profit is ordinary income under the FCT Meyer Emporium. So we already talked about that above. So in certain instances, it might look like capital, but because where is it? But because it was an isolated transaction in the course of carrying on a business, that's the key word, carrying on a business, it becomes income. So in the below instance, so we're flipping it, so it's not actually part of a business. It's a one-off profit-making undertaking, which would be assessable under ordinary income, section 6-5. Okay, so the next very specifically mentioned statutory income in the Income Tax Act 1997 is the disposal of a leased car for profit. So this doesn't come up very often, and the definition is self-explanatory. There is a formula that you need to calculate the notional depreciation on it. If you ever get this in question, just refer back to this section. I'm probably not going to go through it. Just follow the formula. It's not too difficult. The sale of WIP amounts. Okay, I have seen this occasionally in tax rec questions. So if you sell WIP to another company, for example, you might be KPMG and you do professional services, and you have a lot of WIP on your jobs, and you decided to sell your client list, your intangibles, and you've sold your WIP as well, which they can bill to another client. So the amount that you receive for that WIP is not capital, it's actually received, it's put in your assessable income of the seller in the year that the amount was disposed of. So that's section 15-50. So here's a bunch of other very specific statutory income amounts. I'm only going to read out a couple of these, but you can read through them yourself. So royalties, interest on overpayment of tax, excess closing stock over opening stock, partnership distributions, trust distributions, deemed dividends from private companies. So we'll talk about that later when we get to Division 7A. Capital gains, which is probably the biggest one. Might just highlight that one. Reimbursed car expenses. And yes, you can read through those yourself. Ultimately, it doesn't make a huge difference because both are included in your ordinary income. The main type of question you'll get is, for example, they haven't included it because they don't really know how to treat WIP, a sale of WIP, for example. And you need to include that as income under statutory income, and you just need to include the right section reference. And that's it. It's quite simple. So, exempt income. Let's talk about this concept now as well. So, there's two types of exempt income. There's normal exempt income, and there's NANA, non-assessable, non-exempt income. Now, both of these, you do not have to pay any tax on these income. Some examples of these is for just normal exempt income is if you work for the army, for example, your income is often exempt, which means you have to pay tax on it. Child support income. If you are a charity, your income will be exempt as well. This keeps coming up. We've mentioned this before. So non-cash benefit amounts, section 21A. This comes up later. We'll talk about it then. So that's just exempt income. So basically, you don't have to pay tax on it. Now, what is NANA then? So NANA it does exactly the same thing, except it does not reduce tax losses, whereas exempt income does. So if you've got tax losses in that current year, so for example, you've got $1 million of income. Sorry, salaries and wages. $1 million of salaries and wages. And you've got $500,000. You'd have to pay $500,000 tax on that. And you've got $500,000 of losses that you're going to apply to that. So normally, you would have no tax payable in that year. However, you also reported exempt income of $100,000, which means this $100,000 reduces your tax loss, which means you can only apply $400,000 of tax loss against your taxable income of $500,000, which means you still have to pay tax on $100,000. You have to pay tax on $100,000. And that's basically the difference between exempt and NANA. It sounds complicated, but it's really not. Basically, income is not assessable. If it's NANA, it does not reduce your tax loss. This is the preferable one. Or if it's exempt income, it does reduce your tax loss. Okay, so this is going through capital receipts again. So capital receipts, we talked about the distinction between income and capital gains above. So these are just some of the key things you have to consider in a question as to when you're going to allocate this as capital or income. Again, there's different tax implications. As I mentioned before, it was more important back in the day, but it is still relevant today in certain situations. So it is an important concept to understand. So, consider these facts from the background case. Is it a one-off or non-recurring event? California Oil Products Limited v. FCT. I'm not going to mention these cases every single time, but just look over there in column K. You'll see the relevant case law. So if it's a one-off, more likely to be capital gain. If it's non-recurring, more likely to be capital gain, and vice versa for income. Amount received for a restrictive covenant, I believe that is, or restriction of an asset. So this is going to be capital because you are preventing yourself from using the structure that generates income. For example, a petrol station, I believe that is what Dickinson is the petrol station. He wasn't allowed to trade within a certain area, and he was received compensation for that. And basically they deemed that as capital because he couldn't use the capital asset that would generate him income. Payment is not a product of employment, service rendered, any business. So obviously anything from your own personal service is going to be income, not capital. So that's FCT versus Harris. Does not have quality, character of income. So it's very generic. It's talking about the concepts that everyone's familiar of income. Good case just to throw into your response. Lump sum, neither periodic nor regular. So wages come in every fortnight, as we mentioned before, whereas a capital gain, sale of a house, more likely to just be a one-off sale. Gain resulting from merely realizing an investment in the best possible way is capital. So, for example, there was a case, I believe, where a shopping center was holding on land for a long period of time, and they realized the investment to maximize their cash because that was a change of business strategy for them, but it would result in more money coming in for them. Ended up being a capital gain. So you want to reference Scottish Australia Mining Co Limited. Similar to Whitford's beach as well, so they decided that they were going to sell the beach with a view to make the best possible return, and was deemed as capital. Transaction acts occurring outside the ordinary course of business and not entered into with the intention of making profit. So sorry, actually this was the case I was mentioning before. So this is the case where they actually bought a block of land with the intention of develop it into a shopping centre. However, they ended up not deciding that, and they ended up selling it to a block of apartments or something similar. So it wasn't their intention to actually make profit. And it ended up being a capital amount despite that. It entered into with the intention of making profit. So it goes either way with FCT v. Meyer Emporium. Just use it depending on the background facts of the case. So amounts received as compensation as an undissected lump sum will be capital. So this is basically saying undissected lump sum is where they haven't actually allocated an amount for example, your services in here and your equipment over here. It's just one lump sum for the whole amount, more likely to be capital. Of course, there's no one situation where this is definitely capital or definitely income. Again, you've got to weigh up the different facts and which way they're leaning towards being capital or income, and make a judgment based on case law predominantly, but also the relevant section reference from the Tax Act. Okay, so moving forward, again, very small and specific things popping up out of this first chapter. It's my least favorite chapter actually because there's no real substance to it, just a whole lot of random small things here and there which you got to remember, but it needs to be done, so let's go through it. So this is saying no general principle that the reimbursement of a previously deductible amount is assessable. However, it can be ordinary income if the transaction giving rise to rebate is part of day-to-day business. Here's the statutory income. It's a very specific one, so kilometre reimbursements are actually statutory income. Just a random section reference you have to remember and say, yep, that's statutory income. And another very specific rule, so ATO refund of a particularly previously deductible amount, e.g. a refund from FBT is an assessable recoupment. So just to recap, a reimbursement doesn't necessarily need to be assessable. However, it can be ordinary income if it's part of your day-to-day business. And you also need to consider what falls under statutory income. That's kilometre reimbursement. And also there's a specific rule where ATO refund can be assessable as well. Okay, so we talked about the difference between a cash versus accruals. Here is just some more general notes about this distinction. So when you should use each instance. So business taxpayers should use accruals. If you're running a business, use accruals. If you're a small individual practitioner, or think small business is cash, large business is accruals. So let's just move forward. Okay, so here we're going to talk about this section 21A, little tricky thing. So this one's a little bit confusing. The CSG was quite confusing in talking about this. But basically, the old Tax Act basically said one thing. However, the new Tax Act contravenes it. The case law basically said that previously that non-cash benefits are not ordinary income, but then the old Income Tax Act, 1936, writes over the top of that, so you can basically ignore this. I'm not sure why the CSG talks about that to confuse you, but I guess you need to know the history. So 21A counteracts this, writes over the top and says that non-cash business benefits are assessable income, as if it was convertible to cash. For example, they might give you a voucher, and that would be assessable income provided it doesn't fall under one of the following rules. So, number 1, otherwise deductible rule, section 21A, bracket 3. So if the recipient had paid for the benefit, they would be entitled to one-off deduction. So, for example, if you have a professional fee for your chartered accounting, and your employer reimburses you for it, provides you that non-cash benefit, maybe it doesn't fall under FBT, which it should. We'll talk about that later, but just under the guise of 21A, would this be falling under the otherwise deductible rule? Yes, it would, because you as an individual taxpayer would be able to claim that as an education expense. Therefore, it is exempt, and there would be no, you would not have to include that in your assessable income. Non-deductible entertainment expenditure. So, non-deductible, so we talk about whether it's deductible or not later in the FBT chapter, but basically if you pay FBT on entertainment, it's deductible. If you don't, it's non-deductible. So it's actually exempt if it's non-deductible entertainment expenditure, which is a little bit unusual. And the last one, and the most common one, almost used all the time, is low value exemption. So if they give you a Christmas, if they give you a bottle of wine or movie tickets, it's under $300. It's fine. If it's above $300, then it's taxed. That's section 21.1. Okay, so moving on. How much more have we got to go? Okay, we're almost done with the first video. Okay, so the next section is mutuality principle. So this is the concept that a person cannot make a profit when dealing with themselves. What this means is there are certain institutions and legal entities which is not a separate legal entity, it's a group of individuals represented together. Let me give you some examples. So a body corporate, or a club. So a club is made up of members. It's not a separate legal entity, but a club is made up of members. So if members earn money from themselves, it cannot be income under this rule. So here's some examples. A group of individuals contribute to a common fund for common purpose, and the money is returned to contributors on wind-up. Then any transactions between those members in the fund does not create income. Okay, so you create a fund, the money is returned to you if you wind up the fund. Not income, because it's income to yourself. You're earning money off yourself, not income. That's Bohemian Club versus Acting FCT. Must be a clear identity as a class members who contributed and those entitled to distributions on wind-up. So anything to do with winding up an entity and the money going back to you falls under the mutuality principle. Some other examples I mentioned before: strata title, or a club and pub where the members make up this body and earn money. For example, pokies off members in the clubs. That's, you actually don't pay tax on that money under the mutuality principle. Okay, moving forward. So tax offsets. We talked about tax offsets before and how they're so much better than deductions because they don't just reduce your taxable income before your tax rate, they reduce your tax payable after your tax rate. So tax offsets reduce the amount of income tax an individual entity has to pay. It's just talking about the distinction between that and a deduction, which I think you now understand. And even better, so some tax offsets can actually be refundable. For example, excess franking tax offsets. So not only do you get a refund of that tax paid, but if you've got franking credits, excess franking credits, and you're not paying any tax, you can actually get that money back, even if you haven't earned enough income to pay tax on it. Tax offsets can also be convertible into carry forward tax losses. So, for example, if you are a company, and we'll talk about this in the company section, and you have too many franking tax credits that you're probably not going to distribute it out, you can choose to actually convert that into a tax loss. Very specific rule, but don't worry too much. We'll talk about it later. Tax offsets may be lost if not utilized, so it's not very common. The most common ones are franking credits, which that doesn't happen. You can roll that forward. Foreign income tax offsets can disappear. Just a very specific part of that particular offset. Okay, so the two main offsets that we're really going to talk about in the tax module. So there's a foreign income tax offset. We won't really touch on this again until the end. We'll look at international tax issues. And the other one is franking tax offset, which we'll look at quite closely and relatively soon when we look at companies. Okay, so that's pretty much the first chapter, income. So I've just got a screenshot here because it's going to be the most common question in chapter 1 in your quizzes, even in your exams. Almost every exam has at least one tax rec question. So what this does is it reconciles the difference between your accounting profit, so that's what you've got in your financial statements or your P&L, into your taxable income. So it's basically removing the differences between accounting and tax, and you'll learn, and I've got some great notes for you when you get to these questions, which just has a huge list of every different adjustment between tax and accounting and what to do with it. You just look it up and it's done. But basically this is what we'll be doing in the tax rec. We'll start off with our accounting profit, and for example we might add back accounting depreciation, because accounting depreciation is sometimes different to tax depreciation. It might be faster for one or the other. So we're going to add back our accounting depreciation. So we're removing that expense, and then we're going to reduce it by the actual tax expense itself, depending on what the tax depreciation is set by the ATO. You do the same for income as well in the reverse order, but the concept is quite simple. It's just how do you get to your accounting profit to follow all the tax rules that are different from accounting to tax to get to your taxable income, which you report in your tax return. Most companies do that because most companies start off with their accounting and then have to lodge a tax return. And that's it. That's chapter 1. Don't worry about this flowchart too much. We've already talked about it. And that is the end of the general income chapter. It was quite long. We've got residency, deductions, and trading stocks still to go, so watch the next video.